Certainly, in terms of your personal life, the most important decision you'll make is the spouse that most of you will likely have. And it's very important to surround yourself with people that are better than you are.
How Most People Should Invest in 2022 by Warren Buffett. Hey guys, welcome to my channel Money Invest. In my opinion, most investors would feel more comfortable purchasing stock if they knew what they were buying, which is a piece of a larger corporation rather than just a piece of paper. As the world's most successful investor, Mr. Buffett has made an average of 20% per year for Berkshire Hathaway since 1965, which is double the return of the S&P 500, and over the long term, the stock has returned 2.8 million%, which is more than twice as much as the S&P 500 returns over the same period. Now let's look at how most people should invest in 2022. Before we continue, kindly subscribe to our channel and click on the notification bell to get updates on more videos like this from us. So without further delay, discover how to become wealthy before the end of this video. The first lesson we'll cover is to manage your emotions and invest with your mind rather than your emotions. The first one we're going to cover is how you should invest with your mind. Number 2 is to see which are all the opportunities. It's always better to go for it than missing out on great opportunities. After all, if you were right and you didn't invest in the company, you'll regret it and probably make a lot of other mistakes in the future because you'll be desperate to recoup what you lost. Even though the difference between buying it now and holding it for 10 or more years is only $10. If you've done your research and are confident that the business you've chosen is sound, then there's no reason not to buy it now. If you're not confident, however, there's always the option of following the don't be cheap rule. When investing in growth stocks, this may be less critical, but if you follow the value investing approach, it is critical regardless. While fair price is a bit subjective, you can still compare the company to its competitors. For example, if you buy a great company at a great price rather than a great company at a great price. In the long run, trust me, this will work out very well if you don't know how to pick long-term winners. Buffett summarized this simple set of rules quite perfectly in an interview with the Wall Street Journal. We must first deal with difficulties that we can understand, and then we need a long-term competitive edge for the organization we choose. There's no doubt that a management team that is both honest and talented would be preferable to us. The first symptom in an increase in interest rates is an overvalued stock market. So let's take a look at Warren Buffett's recommendations on each of these 3 crucial issues, one at a time. We may not have many opportunities to buy undervalued stocks within our area of expertise this year. According to Warren Buffett, who wrote about this in his annual letter to shareholders in 2019, Buffett said that he hoped to invest much of the company's excess liquidity into companies that Berkshire would be permanent, though not ideal. Berkshire Hathaway's cash reserves have grown from $84.4 billion in the third quarter of 2016 to $149.2 billion in the third quarter of 2021. Do not get trapped into buying ordinary investments in an overpriced market by waiting for a proper opportunity. When you buy a farm, you don't have to worry about how to run it. You just buy the formula, and the tenant farmer will take care of it for you, just like you would if you bought stocks. Similarly, you don't have to worry about how to invest. You just buy the formula and the tenant farmer will take care of it for you, just like you would if you buy stocks. If you buy market tracking investments at regular intervals, rain or shine, you'll end up with an average return on your money over a long period. The market's average annual return is between 8% and 10%. If you keep doing this for years and years on end, the nature of index funds necessitates a long-term approach. Alright. We've made it halfway here, which leads to the next lesson, which is also a very important one. Understand not only the product but the underlying economics of the business, as well as if it's great and you know what the company does, the product works, etc. That's great, but a good product does not imply that the economics of the business translates into a great one. There was no quick success for Warren Buffett, who made most of his fortune only after he became 50. Thus, this lesson is basic but very important. Rule number 1, don't lose money. Rule number 2, never forget rule number 1. And a semi-rule here because I know exactly where my money is invested. I don't have to worry about taking on any more risks. However, if you invest in things you don't understand or in companies you have no idea about, the risk is real and the risk is present, because when everything goes up, if you don't plan on holding a stock for at least 10 years, you shouldn't even consider buying it. For long-term success, the most important thing to do is to invest over a long period and not make any implicit bets by putting a large chunk of it at any certain time. In the long run, the stock market is your best friend. So even if the market falls by 50% tomorrow, you won't be sad. You have to keep in mind one thing in economics: you can't simply do one thing, but you have to question. And then what and what did you know? The zero interest rates and money printing eventually caught up with us. What can we do? Asks Warren Buffett, to combat the current rate of inflation. When inflation in the United States peaked at 20% in 1982, Warren Buffett described this in his annual shareholders letter. As early as 1982, Warren Buffett wrote about the kinds of companies that should be bought when inflation is high. He's referring to businesses that can raise prices without fear of significant market share or unit volume loss, and businesses that can accommodate large dollar volume increases in business, which are often caused by inflation rather than real growth with an only minor additional investment of capital. Price increases can help reduce inflation to some extent, but which corporation would dare to do so without suffering market share losses? It isn't necessary if you have a moat or some other edge in the market. Apple's pricing is always higher than those of its competitors for no apparent reason, whereas Coca-Cola can raise its prices whenever it wants. One can only wonder why Warren Buffett has invested so much money in two alcoholic beverages that consumers refuse to drink. To avoid losing clients or market share if price rise, it's vital to check that the companies you're evaluating have a competitive advantage. Another piece of advice from Warren Buffett is that we need to look for businesses that can handle a large dollar volume increase in business with only a minor additional investment of capital, which means that you should look at the companies that have very scalable business models like Facebook, whereas Ford must build new facilities or recruit more workers if they want to triple profits by 2020. If you're interested in learning more about interest rates, the Federal Reserve has stated that it plans to raise them 3 times in 2022. The US Treasury sold some 4-week notes with an average price of 106 decimal places in decimal places. According to the scenario, Buffett was talking about interest rates and stock market values. Because interest rates are so low, investors have a lot of money streaming into the stock market, which is causing valuations to rise quickly. However, in 2022, interest rates will begin to rise, and the higher they rise, the greater the gravitational pull. Hopefully you enjoyed this video, and if you like to learn more about other great investors, let me know in the comments below. If you're interested in that, just hit the subscribe button, and if you liked this video, hit the thumbs up button as well. Thank you so much for watching.